Hello financial fans, welcome back to another stock analysis. Today we'll be covering Meta Platforms stock ticker META. Meta Platforms is a multinational technology company that provides tools and solutions for the creation and management of online digital businesses. The company is well known for owning Facebook, Instagram and WhatsApp, three of the world's largest and most popular social media networks. With its comprehensive set of tools and services, Meta Platforms makes it simpler and more cost-effective for companies to start and grow their digital businesses without having to build all the underlying technology from scratch. The goal of the company is to provide a full range of tools and services that allow businesses to focus on their core operations rather than having to devote significant time and resources to building and maintaining technology. They're currently sitting at a $451.5 billion market cap, and in 2022 rather than 2021 as it says there, they generated a revenue of $116.6 billion, and they're the 14th biggest company on earth by market cap. 47% of their revenue is generated from the USA and Canada, 25% from Europe, 18% from Asia Pacific, and the remaining 10% from the rest of the world. And their revenue is generated through 40% Facebook, 28% WhatsApp, 18% Messenger, and 14% from Instagram. To determine the final valuation of the company, we'll be using a margin of safety, and this margin of safety will be based on the financial ratios, the financial health, and the growth of the company. I will be using a standard margin of safety of 25%, or 20% rather, that can never be below 0%. The margin of safety can either increase or decrease by the ratios that we're going to look at in just a moment. And the severity that the margin of safety will increase or decrease by will be determined by using a scale. When we're using 4 colors in a scale, bright red will mean a 5% increase, orange will mean no change, light green will mean a 5% deduction, and bright green will mean a 10% deduction from our margin of safety. And when we're using 3 colors, bright red will mean a 5% increase, orange will mean no change, and bright green will mean a 5% deduction from our margin of safety. The first two metrics that we'll be looking at are the EBIT growth and the margin growth. The EBIT has gone up, going from $2.9 billion in 2013 to $33.5 billion in 2022. The average EBIT growth during this period was 36%, which is very massive, and looking at our scale, is a 10% deduction from our margin of safety. The margin has gone down, going from 37% in 2013 to almost 29% in 2022, making a big drop, going from almost 40% in 2021. The average decline was 1.6%, meaning a 5% increase in our margin of safety. The final two ratios that we're going to look at are the debt to EBITDA and the return on invested capital. To get our debt to EBITDA ratio, we have to take the debt of the company, subtract the cash from it, and divide it by the EBITDA. Out of this, we get the amount of years of EBITDA it takes for the company to pay off all of their debts. Looking at Meta's balance sheet, their debt is smaller than their cash position, meaning they can cover all of their debts and liabilities with their cash. In this case, that means a 0% debt to EBITDA ratio because they have no net debt, which is a 5% deduction from a margin of safety. I see now that it says Alphabet in the presentation, but it's supposed to say Meta. The return on invested capital for Meta is 19.7%, meaning another 5% deduction from a margin of safety. So it's looking very good so far for Meta. Let's go look at the valuation models next to determine the intrinsic value of the company. The first valuation model that we'll be using is the discounted cash flow model. I've imported the free cash flow of Meta going from 2013 to 2022. The average growth in free cash flow during this period was almost 32%, and I'm projecting an expected growth rate in free cash flow of 8% in the next 10 years. With this percentage, we could determine the future free cash flow of Meta and determine a terminal year valuation using a perpetual growth rate of 3% and a discount rate of 9%. This leaves us with a sum of free cash flow of $445.4 billion, and to get our equity value, we have to add the cash and equivalents and subtract the debt, leaving us with an equity value of $459.5 billion. All that's left to do to get our discounted cash flow price per share then is to divide it by the amount of shares outstanding, leaving us with a price per share of $206.09. This is an 18.3% upside from the current price out of this model. The second model that we'll be using is Graham's revised valuation formula. In this model, we look at the earnings per share that Meta is generating, the growth rate estimate that Wall Street is projecting, and the current yield of AAA corporate bonds. And we go by the theory that the PE of a company with no growth is always 7. Looking at all of these metrics, we get a fair value of $114.24, which is a 34.4% downside out of this model from the current price. The third model that we'll be using is the multiple valuation. In this model, we'll be looking at similar companies to Meta, although it was quite hard to find some of them, so I chose some of the big tech giants. We'll be looking at the stock price and the earnings per share, so we can determine the average PE multiple in the industry, which in this case is 25.09. All that's left to do to get our fair value is to multiply by the earnings per share that Meta is generating, which is $8.16 a share. This gives us a fair value of $204.71, which is a 17.5% upside from the current price. And the final model that we use is the mean reversion theory. In this model, we go by the theory that a company will always trade above or below its mean. And the metric that we use to determine this is the PE ratio. The average PE ratio over the past 5 years has been 23.24. And the current PE ratio is 21.34, meaning that it's currently under the mean. This indicates that the stock is currently slightly undervalued. And this gives us a fair value of $189.64, which is almost a 9% upside out of this model. Let's go look at the final overview of our valuation models next. Looking at our final overview, we've imported the discounted cash flow, Rame's valuation, the multiple valuation, and the mean reversion theory prices per share, leaving us with an average of $178.67. We've determined the margin of safety earlier using a standard margin of safety of 20%, deducting 5% for the debt to EBITDA, 10% for the EBIT growth, adding 5% for the margin growth, and deducting another 5% for return on invested capital, leaving us with a 5% margin of safety. Applying this margin of safety, we get a fair value of $169.74. And with the current price of $174.15, this is a very small downside of 2.5%. So in this case, it's very close to the fair value. If there's any other companies that you would like to see me cover on this channel, please let me know, and thanks for watching.